Ray Dalio, Michael Berry, Warren Buffett, and almost everyone around the world have all spoken about the incoming inflation in the previous few months. And now that inflation has started taking off, it's clear that their predictions were spot on. Not only that, but the vast majority of financial experts anticipate a sustained increase in inflation over the next few years. Cathie Wood, being the classic contrarian, would expect the exact opposite: deflation. Cathie believes that while inflation has been anticipated, a deflationary crash is the true black swan occurrence. Now we know you're already quite hooked about what she has to say, which is why for today's video, here at Tech Tank Titans, we'll explain in detail Cathie's argument and her supporting evidence regarding this matter. But before we go on, please make sure to give this video a thumbs up and hit the subscribe and bell buttons to stay updated for more of our uploads. But for now, we won't waste a minute or two. So, let's get started. We must hear what Cathie Wood has to say without judgment because she began her career as an economist and has decades of expertise to back up her arguments. In reality, prominent economists like Henry Kaufman and Milton Friedman predicted that inflation would persist until the 1980s. However, a young economist named Cathie Wood concluded that inflation was beginning to subside. Predictably, Cathie turned out to be correct in the end. Cathie Wood is betting against conventional wisdom by asserting that a slowdown in the growth of the money supply will be the first sign of inflation slowing down. Since the beginning of the pandemic, there has been a dramatic increase in the availability of M2 currency. In the United States, the total amount of money in circulation is measured by a quantity known as M2 money, which encompasses everything from savings to checking accounts, to cash, to money market funds, to CDs. A significant increase in M2 money is hardly surprising, given the popularity of stimulus checks. Cathie Wood, on the other hand, has noticed a marked slowdown in the expansion of M2 money. The year-over-year rate of increase in M2 money supply has decreased from 27 in April to barely 17 in May. The recent bond market surge can certainly be attributed to this slowing in growth, since bond yields and bond prices are inversely correlated. The yield on 10-year Treasury bonds has been kept at around 1.5% since it peaked at 1.7% in March. Bond prices have been rising as yields have been falling. Anytime this occurs, it's a sure sign that bond investors expect deflation rather than inflation. We say this because what we just said regarding money growth may be contributing to the current bond market surge. Money growth has slowed from 27% to 13.8%, but we don't know of any economists who have noticed this. Perhaps that's what bond traders are thinking about. You would assume that the Federal Reserve's bond buying program is responsible for the bond market's recent gains, but in reality, the Fed has been buying bonds for months, so this isn't a brand new issue. Even when bond yields soared in March, the Fed's purchasing power remained stable. The Fed's ability to spend was undiminished. In fact, in the wake of the high inflation reports, they intended to unload some of the corporate bonds and corporate bond ETFs it had acquired during the pandemic. Similarly to every other economist, Cathie Wood anticipated a bond market sell-off. Nevertheless, bonds have basically continued to rally, but I will tell you, with the CPI numbers that we have gotten PPI as well as considerably higher than predicted. Although we anticipated interest rates to rise as a result of bond market selling, they actually fell. Since the end of March, the 10-year Treasury bond yield has declined from 1.74 to 1.43. Bond prices are rising. despite solid economic data and high inflation rates. Now, many would say, well, it's just quantitative easing. And although we agree that this was true at the start of the year and through March, when we moved to 0.9 to 1.74, we don't think anything has changed here. The bond market, though, seems to sense a change. Cathie Wood may sound completely off her mind, but she believes inflation will continue for at least another few months. The Personal Consumption Expenditures Price Index has shown that prices have grown 1.6 year over year in February to 3.9 in May. Cathie, on the other hand, speculates that this inflation rate could reach 5%. She predicts that costs will fall over the long term, despite the fact that inflation could spike in the coming months due to rising oil prices. The Organization of the Petroleum Exporting Countries, or OPEC, is committed to recouping lost earnings by maintaining a low oil supply. Despite the fact that this seems counterintuitive given the rising cost of energy, electric vehicles have been experiencing a surge in popularity among consumers during the epidemic. Sales of electric vehicles or EVs have skyrocketed in comparison to sales of vehicles fueled by traditional fossil fuels or FFVs, a trend attributed in part to rising gas prices and in part to the perception that EVs are safer. Long-term demand for oil crude will be reduced if oil prices rise because more people will be encouraged to buy EVs. The price of a barrel of oil is hovering around $75, very close to the all-time high of $77. Cathie predicts that the price of oil will drop to between $3 and $12 per barrel in the future. This is a reduction of $84 based on today's pricing. Significant deflation would occur if these low prices materialize. In addition, this is because OPEC has the capacity to produce an additional 5 million barrels per day. The continued high price of oil is crucial to their ability to meet budgetary obligations, but at some point, companies may find that their price strategies are really destroying demand. We do believe they will begin production, and as you know, we anticipate that oil prices will decline in the long run as a result of the widespread adoption of electric and autonomous electric vehicles. We haven't done the groundwork to get here yet, but we wouldn't be surprised to see oil prices fall to where they were after the cartel took over in the early 1970s when they had risen from $3 or $4 a barrel to $12. Eventually, to get us back here, particularly as sales of electric vehicles rise as they begin to grab a sizable market share. Moreover, the dollar's purchasing power is a signal of deflation. The dollar index has risen sharply during the past month. This obviously contradicts worries about dollar inflation, as the dollar is strengthening against other currencies. This may be the result of Biden's corporation and capital gains taxes being lower than anticipated. Lumber prices in particular have suffered a sharp nosedive, something that was anticipated by Cathie Wood well before it happened. Cathie notes a few more indications in the video, including the price of copper and the price of pork in China. We believe that at the beginning of this year, the consensus short in terms of currencies was on the dollar. And the fact that the dollar is not moving down is consistent with the decline in bond yields. Real consumption falls 0.4% month over month. Consumption of durable goods falls 4.3% month over month. And consumption of non-durable goods falls 0.5% month over month. Services consumption, however, is up only 0.4% month over month, which is not enough to offset the 0.6% drop in goods consumption. The recent decline in commodity prices, increased demand for consumer products, and slower rise in the money supply suggest that inflation may not be as dire a situation as you fear. Many counter-arguments have been made, such as Ray Dalio's denouncement of the bond bubble and Michael Burry's prediction of impending hyperinflation. We don't think inflation will be an issue in the long run. Inflation may be higher than projected in the short term, however, due to rising consumer spending. But what are your thoughts about this one? Please let us know what you think by sharing your ideas in the comment section below, and we'd be more than happy to join in the discussion. Besides that, thanks for watching. Make sure to click the like, subscribe, and bell button for more Tech Tank Titans' latest technology and stock market updates for you. Thanks again for watching, and we'll see you on our next video.